Okay, Bismillahirrahmanirrahim. Assalamu alaikum, everyone. Thank you for joining this AFM revision marathon session. So my agenda for today is that I shall try to go through the AFM syllabus. I would try to cover the maximum areas of the syllabus. It's mainly going to be a revision. I won't be focusing on the question practice. I would rather be focusing more on the revision. That's what I would be doing. Now, what I would actually want you people to do is that to actually, as we progress along, you can just note down your queries. You could just note down your issues. And once I actually stop, then you can ask your questions. But inshallah, hopefully, inshallah, it is going to be a beneficial session for you all. And you all would be able to, inshallah, get a lot of revision from this. So I'm just going to start off. There are a few questions which are always asked. So let me just answer those questions first, which is number one, you would be getting the recording for this at the end of the session, probably by tomorrow. The second thing is that you can ask questions at the end of the sessions. If I think that I can answer them right now, I would answer them right now. If I cannot, I would just revert back to you later on by tomorrow or day after. Furthermore, there is a common question, which is what is important area. So I say everything is important, but again, I would just try to make some guesses of mine by the 1st of September, which is one day after tomorrow. And then furthermore, probably there's something that is like you people might have some questions. So you may just go on asking those questions as soon as we progress along. Okay, let's start discussing. So basically, the first topic that I'm actually going to start off revising is basically, I would start off with the weighted average cost of capital. So let me just recall the weighted average cost of capital, that whenever we talk about the calculation of the weighted average cost of capital, so we know the weighted average cost of capital could be used as a discount rate. Furthermore, it's actually also termed as a benchmark rate, that the rate that any organization would want to achieve if it wants to undertake a project or investment or anything. Now, when we talk about the formula for the WACC, the formula for the WACC is actually like this: cost of equity multiplied by market value of equity divided by market value of equity plus market value of debt. Plus you do KD 1 minus T multiplied by market value of debt divided by market value of equity plus market value of debt. Now, when we talk about all of this, what are we going to do? We're going to say that KE is the cost of equity. This E is the market value of equity. This D is actually the market value of debt. This KD is the cost of debt. And when we talk about this KD1 minus T, this KD1 minus T is actually termed as after-tax cost of debt. Now, when we talk about the computation of the cost of equity, the cost of equity could be calculated using two methods. What are those two methods? One of them is called CAPM approach. The other one of them is called dividend valuation model. So when we talk about the CAPM model of the cost of equity calculation is like this, where we say cost of equity is RF plus equity beta into RM minus RF. Now what actually happens is that the cost of equity is actually equivalent to RF, which is the risk-free rate of return, which is actually going to be considered as the risk-free rate of return. Then you've got BE, which is going to be the equity beta. Then what do we have? We have got the RM, which is the market rate of return. We have got the RM, which is called the market rate of return. And then in addition to this, we have got another one of them, which is actually the RM minus RF. What is it? It's actually called the RM minus RF. So when we talk about the RM minus RF, this is actually going to be considered as the risk premium. So when you calculate the cost of equity using the dividend, this capital asset pricing model, this is the formula, which is KE is equivalent to risk-free rate of return plus equity beta into RM minus RF. Where risk-free rate of return is the rate of return of the government bond generally. The equity beta is the market risk coefficient and the RM is the market rate of return. So that is what it is. Similarly, when we talk about the dividend valuation model, so you would remember that the dividend valuation model is basically a share price valuation model. The formula of which is D P naught is equivalent to D naught 1 plus G divided by KE minus G. What we do is that we rearrange this formula, and when we rearrange this formula, the rearrangement of the formula leads to a formula which is D naught 1 plus G divided by P naught and plus G. So now when we talk about this whole formula, I'll just talk about each one of the components of the whole formula, that what are each one of the components of the whole formula going to be. So when we talk about each one of these formula, the D naught is the current dividend. The G is the dividend growth rate. The P naught is the current X dividend share price. So when we talk about the concept of this current X dividend share price and etc., now let's just move a bit forward and let's just discuss further. The next aspect is basically when we talk about the share price. The share price could be of two types. What are those two types? One of them is X dividend share price and the other one of them is called cum dividend share price. What is an X dividend share price? What is a cum dividend share price? The X dividend share price actually means excluding dividend. And the cum dividend share price actually means cumulative of dividend. So you've got X dividend share price, which is excluding dividend. The cum dividend share price means cumulative of dividend. So like, for example, if a company's share price right now is $20 and if it announces a dividend of, let's say, $3 per share, its share price is going to become 23. So when its share price is going to become 23, this $20 is going to be considered as X dividend share price. The $23 is going to be considered as cum dividend share price. So there could be an excluding dividend share price. There could actually be a cumulative of dividend share price. So there could be two different type of share prices that could actually exist. Now let's just move a bit forward and let's discuss further. So what happens is that in the dividend valuation model, when we talk about the growth rate of the dividend, there are two approaches to calculating the growth rate. And what are those two approaches? One of them is called geometric mean method, and the other one of them is called Gordon growth model. Now, what is this geometric mean method going to be? What is this Gordon growth model going to be? So when we talk about the geometric mean method, you use the historical growth rate. So how do you calculate the historical growth rate? Let me just guide you about the historical growth rate. So let's say, for example, if you had a dividend of 2015 to be, let's say, $2, and in 2020, the dividend is actually turning out to be, let's say, $2.75. So what are you simply going to do is that you're going to say $2 is equivalent to, it's actually going to be $2 multiplied by 1 plus G power. Power is going to be what? Power is going to be, you got to see how many times the dividend is growth. So 16, 17, 18, 19, 20. So 1, 2, 3, 4, 5. So it's going to be 5 is equivalent to 2.75. So hence what actually happens is that 1 plus G is equivalent to 2.75 divided by 2. 2.75 divided by 2 root power 5, and you can actually end up getting the dividend growth rate. So one of them is actually the formula which is called the geometric mean method. The other one of them is called the Gordon growth model. Now what exactly do you mean by the Gordon growth model? So under the Gordon growth model, we have got a formula which is G is equivalent to BR. Now, what is this G is equivalent to BR? What is B? What is R? So the concept of B and the concept of R, B is actually your retention ratio, and R is actually your rate of return. So now what actually happens is that when you have got this retention ratio and the rate of return, so retention ratio actually means what? When you earn the profits, let's say your profit is 100 and you pay a dividend of, let's say, 30, so 70 goes to the retained earning. So your retention ratio is going to be 70%. I repeat, your retention ratio is actually going to be what? 70%. So basically what happens is that the R is actually considered to be the rate of return. The rate of return could be the return on asset, the rate of return could be the return on capital employed, the rate of return could actually be your return on equity. It could be anything. So you could just have a rate of return which could be anything reflecting anything. So the growth rate of the dividend could be established using either the geometric mean method or the Gordon growth model. Now let's move a bit forward and let's discuss further. So amongst the different components, one of the component was to calculate the cost of equity in the WACC calculation. The second thing that we are going to talk about, I repeat, the second thing that we are going to talk about is about the cost of debt. So when we talk about the cost of debt, how exactly do we have the cost of debt? So let's try to understand this. The cost of debt could actually be calculated using depending upon that what type of debt do you have. So for example, the different type of debts that you can actually have is that one of them is called redeemable debt. The other one of them is called irredeemable debt. For the redeemable debt, there could actually be traded debt, and there could actually be non-traded debt. There could actually be a traded debt. There could actually be non-traded debt. So basically what happens is that if I actually talk a bit further about it, so just try to understand this thing, that if you've got a debt, always remember that you calculate the KD 1 minus T, which is the after tax cost of debt is considered. So the example of the traded debt is simply the bonds which are traded. The example of a non-traded debt is going to be the bank loans, etc., that are going to be there. Now what happens is that for the traded bond, what are we going to do? We're going to calculate the IRR. That IRR is going to be considered as the cost of debt. When we talk about the non-traded debt, the non-traded debt is actually the interest percentage multiplied by 1 minus T. It's going to be the interest percentage multiplied by 1 minus T. And when you've got irredeemable bonds, the irredeemable bonds, one of the example is basically the perpetual bond. One of the example is actually the perpetual bond. Now, when we talk about the concept of the perpetual bond, the concept of the perpetual bond is going to be like the bonds which always remain in issue. The bonds which always remain in issue, that is going to be considered as a perpetual bond. Now, the perpetual bond, how do you calculate the cost of it, which is after tax interest divided by market value of the bond. So whatever the after tax interest divided by market value of the bond, that is what it is going to happen with respect to the perpetual bond. Now let's just move a bit forward. Let's just have a bit discussion further. The next thing that we need to understand is basically there is something which is called preference share. There's something which is called preference share. Now when we talk about the preference share, so the cost of preference share, which is given a hint of KPref. KPref is your preference dividend divided by X dividend market value of preference shares. So what happens is that the preference dividend divided by X dividend market value of the preference share, that is going to be something that will happen. Right now, one more thing that I want to tell you people, that at times what happens is that when we just write down a WACC in a form of a statement, it becomes a very, very big statement. So what I would suggest and what I would recommend you people to do is that in case if you have got a WACC, which is like you've got 3, 4, 5 sources of debts and the finances and etc. So what is it that you need to do? All that you have to do is that you have to make sure that you create a table. How do you create a table? You create a table like this. Like for example, you could say the cost in terms of percentage. You could say the value in terms of dollar. Let's say, for example, you've got equity, you've got the debt one, you've got the debt two, you've got the preference share, etc., etc. Let's say that you've got 10%, you've got 8%, you've got 6%, you've got 5.5%. Let's say this is 100,000. Let's say this is 200,000. Let's say this is 300,000. Let's say this is 50,000. So one way of actually calculating the WACC is that you could just do one cost calculation in terms of dollars. Let's say you do this 10% into 100,000 gives you 10,000. You do this 8 to the 16. So this gives you 16,000, 6 3 is 18,000. And then what happens is that 5.5 into 50,000. So approximately, I think it's 2750. So whatever this total is, and whatever this total actually turns out to be 3 plus 6, 650,000. So whatever when you have to calculate the WACC, you could do the WACC calculation using this amount divided by 650,000 multiplied by 100 gives you an X percentage as the weighted average cost of capital. Now, let's move a bit forward. So I've actually reviewed the whole weighted average cost of capital, that how do we actually calculate the weighted average cost of capital. Obviously, there are many things there are many things that are actually there. So we could just, it's just a quick revision that I went through. Now, there's something that is actually the concept of risk adjusted WACC. Now, let me just guide you about the risk adjusted WACC, that what exactly do we have the risk adjusted WACC. See, when we talk about the beta, you need to understand that there are actually 3 different types of beta. What are those 3 different types of beta? The 3 different types of beta that are actually there is that one of them is termed as asset beta. The other one of them is called the debt beta. And the third one of them is called the equity beta. So I repeat, there are 3 different types of betas. What are those 3 different type of beta? You could have an asset beta, you could have a debt beta, and you could have an equity beta. Now, the asset beta, what does it do? It actually tells you about the business risk of the organization. When we talk about the debt beta actually tells you about the financial risk of the organization. And when we talk about the equity beta is a mixture of the business risk plus the financial risk. So I repeat, the equity beta is actually going to be the mixture of the business risk plus the financial risk. That's what the equity beta is going to be. Now, let's try to understand. So the asset beta is denominated by this BA, this is BD, this is BE. Now, what happens is that there is actually a connection between the asset beta and the debt beta and the equity beta, which is the asset beta is equivalent to the equity beta multiplied by market value of equity plus market value of equity plus market value of debt 1 minus T, plus the debt beta multiplied by market value of debt 1 minus T divided by market value of equity plus market value of debt 1 minus T. Now, basically what happens is that it is generally assumed that the risk involved with the debt is negligible. So therefore, debt beta is assumed to have a value of 0. Albeit it is usually assumed that the risk involved with the debt is negligible. Therefore, the debt beta is assumed to have a 0.000 basically value. So hence what happens is that as a result of this, let me just explain to you. The asset beta is going to be equity beta multiplied by E upon E plus D 1 minus T. Now, so there is something that you need to understand as a connection. This is also given in the formula sheet in the examination, but you just need to understand the connection. So the asset beta is also termed as all equity beta. The asset beta is also termed as all equity beta, right? And this equity beta is also termed as geared beta. Another name for the asset beta is ungeared beta. Another name for the asset beta is ungeared beta. Now let's try to understand something. Basically what happens is that whenever you undertake a project, I repeat, whenever you undertake a project, will basically either the business risk or the financial risk changes. I repeat, whenever you undertake a project where either the business risk or the financial risk changes, how would the business risk change? How would the financial risk change? The business risk would change in case if you are getting into a new line of business, in case if you are getting into a different line of business, so automatically the business risk is going to change. And how do we have the financial risk that actually changes? So the financial risk actually changes usually when you have got a change in the gearing. When the gearing changes, the financial risk actually changes. I repeat, when the gearing changes, the financial risk actually changes. Now try to understand something. So I repeat, I'm telling you that once either the business risk or the financial risk changes, so what happens is that the existing WACC cannot be used as a discount rate. I repeat, if existing WACC, if either of the business risk or the financial risk changes, the existing WACC cannot be used as a discount rate. That's something that you would have to keep in mind. Now let's try to have a discussion about it. Basically what happens is that so what do? We actually calculate risk adjusted WACC. So steps for calculating risk adjusted WACC are these. The number one of them is that you have to identify the proxy company. That's number one of them. Then what you have to do is that you have to calculate. I repeat, you have to identify the proxy company. Then the second thing that you have to do is that you have to calculate the proxy. Just wait a bit, I'll just do it. Now, first of all, what you have to do is that you have to identify the proxy company. Then you have to calculate the proxy. Then you have to calculate the proxy equity beta. The third step is that what you do is that you de-gear, which we also call ungear, the proxy equity beta. The fourth one of them is you re-gear the proxy beta at proposed levels of gearing. What you do is that you re-gear the proxy beta at proposed level of gearings. Now, when you re-gear the proxy beta at proposed gear of gearing, so what happens is that calculate KE using re-geared beta. calculate the KE using the re-geared beta. Now, number 6 is that the revised KE to be used for calculating WACC. The revised KE to be used for calculating the weighted average cost of capital. So when we talk about the risk adjusted WACC, these are the steps that you have to follow whenever you're going to calculate the risk adjusted WACC, which is identifying the proxy company, then calculating the proxy equity beta, then de-gear or ungear. De-gear, ungear means actually what you have to do is that you have to convert this equity beta into the asset beta. Now you have the proxy asset beta. That actually means that you've got the business risk of the proxy company. And what you do is that you convert this into the equity beta of the new company on the basis of its gearing. And then you calculate the KE using the re-geared beta and so on and so forth. Now, let's move a bit forward and let's discuss about it. Basically, what happens is that at times in the scenarios, you come across the proxy company, and that proxy company has got multiple lines of business. It has got business segment A, it has got business segment B, it has got business segment C, etc., etc., etc. So now in that specific case, what you need to do is that you need to understand that how is the proxy company's constitution takes place. I mean, in that case, you need to understand that how does the proxy company constitution actually takes place. So let me just guide you about that how does the proxy company constitution takes place. Let's say that the asset beta of sector A is 0.7, 1.3, 0.35. Now what happens is that you would identify that what proportion of the proxy company is sector A, sector B, and sector C. This proportion could be on the basis of your sales. This proportion could be on the basis of your equity values. This proportion could be on the basis of your asset values also. So I repeat, the proportion of the business could be on any basis, like sales value or total sales as a proportion of total sales, assets as a proportion of total assets, the equity as a proportion of total equity, things like that. Now what actually happens is that, let me try to understand this. Let's say if there is this sector A, what happens is that if this segment A constitutes 20% of the business, this constitutes, let's say, 50% of the business. This constitutes 30% of the business. So what happens is that in that case, what happens is if you have to calculate the equity beta of this company, I have identified that it could be on the basis of sales or on the equity values or on the asset values. It completely depends upon you that which method you use. You can just mention the assumption in the exam. Now, what happens is that when I talk about the weighted average asset beta, how exactly am I going to do it? I'm simply going to do it like this. I'm saying 0.7 multiplied by 20% plus 1.3 multiplied by 50% plus 0.35 plus 0.35 into 30%, right? So what actually happens is that you will end up getting the weighted average asset beta of the company in this specific manner. And once you have got the asset beta, you could convert it into the equity beta by applying the proposed level of gearing. So at times you have to understand that how is the asset beta of any business constituted. Asset beta of any business is constituted on the basis of the proportion of the XYZ business risk and their proportions. Now, so for example, if you come across a proxy company which has got 3 segments and you are being given the proxy equity beta. So what is it that you need to do? First of all, you need to convert this proxy equity beta into asset beta, and then asset beta has to be converted into the segment wise, segment 1, segment 2, segment 3 asset beta. So you have to establish the segment 1, segment 2, segment 3 asset beta. So identify, I mean, like whatever, let's say if the industry in which you invest into is similar to the segment 2. So you would pick out the segment 2 asset beta, and that segment 2 asset beta would be used for the regearing and for ultimately calculating the risk adjusted WACC and the cost of equity. That is what is actually going to happen. So basically, that's all about the weighted average cost of capital and how the risk adjusted WACC and how the risk adjusted cost of equity, etc., is going to be calculated. Let's move a bit forward and let's talk about the concept of yeah, thank you. Now let's talk about the concept of investment appraisal. Now, when we talk about the concept of investment appraisal, there are different type of techniques which we go about with respect to the investment appraisal. And those different type of techniques could actually be profit-based technique. Those different type of techniques could actually be cash flow based techniques. So you could have different type of techniques. It could be profit-based techniques. It could be cash flow based technique. Let me just explain to you what is a profit-based technique, what's a cash flow-based technique. Let me just guide you people through with this. So in the profit-based technique, there is only one technique that is there, which is called accounting rate of return. For the cash flow-based technique, there could be different type of techniques. One of them is called payback. Then there is this discounted payback. Then there is this IRR. Then there is this NPV. Then there is this APV. Free cash flows. So there could be different type of techniques that could actually exist. The accounting rate of return, the payback, the discounted payback, the internal rate of return, NPV, APV, free cash flows, etc., etc. Now let's just have a bit of a discussion that what exactly are all of them. So let's try to have a bit of a discussion about all of them right now. Now, if I talk about the accounting rate of return, the formula for the accounting rate of return is basically average annual profit divided by average capital employed. So what is it going to be? It's average annual profit divided by average capital employed. Now, how exactly are we going to go about it? The average annual profit divided by average capital employed. Let's try to have an understanding of this. So let's say, for example, you purchase an asset and that purchase an asset that had a cost of 5 million and that had a residual value of 0.2 million. The life of that asset is, let's say, 10 years. Now, over the 10-year life, we are expecting that the profits that are going to be generated out of this asset is going to be 100,000 in the year one. It's actually going to be 100,000 in year one, and then it would, let's say, remain constant for the next 2, 3, 4, and 5 years. And then the profits is going to be 400,000. Then profit is going to be 450,000. Then the profit is going to be, let's say, 500,000, so on and so forth. 500,000. So this is year 6. This is year 7. This is 8, 9, and 10. Wait a bit, please. Okay, so basically what happens is 100,000 in year 1, 100,000 in year 2, 3, 4, 5, and then 6, 7, 8, 9, 10. So different profits in different years. Now, what are you going to do? You're going to say that let's just try to calculate the average profit. How are you going to do the average profit? So it's 100,000 multiplied by 5 because 1, 2, 3, 4, 5, 100,000 each, plus 400,000 plus 450 plus 500,000 into 3 years. So hence resultingly what's going to happen is that I might have to just pick up my calculators in case if any one of you could actually help me out that what is going to be the average profit on the basis of all this calculation. Yes, please. In case if any one of you could help out. I think I have just forgotten my calculator somewhere. So I am probably without the calculator. Now I would have to rely upon you people. So you got to share with me that what exactly is the answer to it. I don't know. No. Okay, 2,850,000, right? I mean, like, this is okay. This has to be divided by 10. So this actually means 285,000 is your profit per year. Now what happens is that you would say average capital. The average capital is going to be opening plus closing divided by 2. So how would you have the opening capital? The opening capital is going to be 5 million plus the closing capital is 0.2 million, right? So it's 0.2 million, 5 million plus 0.2 million divided by 2. So this actually gives you 2.6 million as the average capital employed. If you want to calculate the accounting rate of return, the accounting rate of return is going to be like this: 285,000 divided by 2.6 million, giving you how much? 12 point something or 11 point something? Yeah, can you do the calculation, please? Okay, 10.9%. Now, you've got 10.9% as the accounting rate of return. Now, what are you going to do as an entity? So basically what's going to happen is that you would compare it with your desired rate. Let's say if your desired rate, I repeat, let's say if your desired rate is 9%, you would invest in this asset. If your desired rate is 10.5%, you would still invest in that asset. But if your desired return is, let's say 11%, you would never invest in that asset, right? You would never invest in that asset. So basically, you just need to understand that what exactly is the concept of accounting rate of return. Now let's move a bit forward and let's talk about the concept of the payback period technique. But before I go on to payback period technique, let me just guide you that what happens is that this payback period technique is actually a cash flow based technique. So whenever we talk about the investment appraisal, the cash flows that we actually talk about, they are the relevant cash flows. The cash flows that we talk about, they are the relevant cash flows. What exactly do you mean by the relevant cash flows? Try to understand this thing. The concept of the relevant cash flows is that the relevant cash flows are directly attributable. The relevant cash flows are incremental. The relevant cash flows include the opportunity cost. So basically what happens is that if you are undertaking a project or if you are undertaking an investment, all that you have to do is that you have to consider the relevant cash flows. And what are the relevant cash flows? They're directly attributable. That is arising because of investment decision. The second thing is that they're incremental. Incremental actually means differential. Incremental actually means differential. That is if, let's say, for example, your existing sale was 100 million and now your sales become 125 million. So 25 million is going to be the differential. I bet 25 million is going to be the differential. The third thing is that the relevant cash flows include the opportunity cost. The opportunity cost is basically the benefit that you forego. The benefit foregone is going to be considered as your opportunity cost. I repeat, the benefit foregone is going to be considered as your opportunity cost. Now, what is it that you need to understand? So I just told you that it's directly attributable, it's incremental, and it's opportunity cost. Let's move a bit forward and let's talk about it. So what are not relevant? So what are not relevant are basically past cost, which are also termed as sunk cost. They're not relevant. The past cost, or we call it the sunk cost, they are not relevant. The second thing is that the committed cost, they are not relevant. The allocated overheads, they are not relevant. So when we talk about the concept of the cash flows not being relevant, so what exactly do you mean by the cash flows which are not relevant? So I've just explained to people that what exactly are going to be the cash flows that are not relevant. Now, right? So they are not relevant. You ignore these cash flows, you ignore these costs. Now let's move a bit forward and let's discuss further. Furthermore, what happens is that there is an important concept when it comes to the timing of cash flows. So the timing of cash flows with respect to everything is that you need to understand what do we mean by the timing of cash flows. So timing of cash flows is right now, whatever that happens right now, it's called time period zero. Whatever that happens in first year is assumed to arise at time period one. Whatever that happens in second year is assumed to arise at time period two. That's how things go about. So the timing of cash flows is also important. That is in first year, in second year, and so on and so forth. Now, let me just move a bit forward. So basically at times what happens is that if something is said that start of the year, if we say end of the year, so start of the year actually means what? Start of the year could actually means like start, if it says start of year one. So start of year one means time zero. If it says start of year two, this means time period one. If it says end of year one, this means one. If it says end of year two, this means two. So you got to understand the timing of cash flows, that when exactly do we have to actually when exactly do we have to put in the cash flows, and at what time period do we have to put in the cash flows. That is something that you have to understand. Now, what happens is that one of the approaches for the calculation is called the payback period technique. Now, when we talk about the concept of payback period technique, what exactly do we mean by the payback? Payback actually refers to the time taken to recover original investment. I repeat, the time taken to recover the original investment, that's going to be considered as what? That's going to be considered as the time taken to recover the original investment is going to be considered as payback period. For example, there could actually be a situation where you have got constant cash flows. I bet there could actually be a situation where you could have a constant cash flows. Now, when you have got the constant cash flows, so the formula for calculating the payback period is that the investment divided by annual cash flows. The investment divided by annual cash flows, right? So what actually happens is that you've got the investment divided by annual cash flow. That is going to be the payback period. Like for example, if you have got an investment of 100,000, and if you've got an annual cash flow of, let's say, 25,000. So what happens is that 4 years is going to be a payback period. I bet what happens is that 4 year is going to be your payback period. Now, what next is there? For example, if it would have been 100,000, and if it would have said that like the annual cash flows is 30,000. So this is going to be 3.33 years. The 3.33 years would actually means what? Would actually mean 3 years. What actually means 3 year, 0.33 into 12 actually means 4 months. So it would have actually meant 3 year, 4 months. I bet what it would have actually meant, it would have actually meant 3 year, 4 month. Is that okay? Now, let's move a bit forward and let's discuss further. So basically what happens is that there could actually be a case where you can have variable cash flows also. So like for example, whenever you've got the variable cash flows with respect to the payback period, so ideally what you should be doing is that you should be creating a table which should say here the cash flow, and then there's this cumulative cash flow. So 0, 1, 2, 3, let's say 100,000 is you have invested at time period 0. 37,000 is what you have received in year 1. So maybe 100,000 and this 37,000. So you would actually say that it is going to be 63,000. Then what happens is that, let's say if there is this 55,000, so you would say we are still at negative 8,000. And let's say if there is this 40,000, so you would say we are standing at 32,000. Now, your payback would lie somewhere between year 2 and year 3. I repeat, your payback would lie somewhere between year 2 and year 3. Now, what happens is that what is going to be the payback? The payback is going to be 2-year plus. Now, there is an 8,000, which is the cumulative outflow. There's an 8,000, which is going to be the cumulative outflow. So you would say divided by 40,000 is what we are expected in the next year. So 8,000 divided by 40,000, 330 here. And this is 2, and this is 4 to the 8, 410, 2 divided by 10, so 1 upon 5. So this actually means 2.2 years. 2.2. Again, you could convert it into months and so on and so forth. So what actually happens is that when I tell you something with respect to this a specific payback, even if there is a variable cash flow, you would just create a table and you would calculate the payback on the basis of this. Now what happens is that there is something which is called discounted payback. Obviously, from the perspective of the exam, you would be using the Excel, the spreadsheet. So, but still, let's just try to understand that when we have got the discounted payback. So try to understand how do we calculate the discounted cash flows. I repeat, how do we calculate the discounted cash flows? So the discounted cash flows could be calculated in 3 manners. Either you have got variable cash flows, you have got constant cash flows, or you have got infinite cash flows. So like for example, if you have got variable cash flows, means year 1 something, year 2 something, year 3 something. So you would use the present value factor, the PV factor. The formula for the PV factor is 1 plus R power minus N. The second thing is that when you've got the constant cash flows, like constant cash flows for year 1 till 5, year 1 till 8, year 1 till 10, so on and so forth. So what are you going to do? You're going to use the annuity factor. The annuity factor is 1 minus 1 plus R power minus N divided by R. And lastly, when you've got infinite cash flows, so what do you use? You use the perpetuity factor. You use the perpetuity factor, and the formula for the perpetuity factor is 1 upon R. I repeat, the formula for the perpetuity factor is 1 upon R. So just try to understand something, that when we talk about the concept of this discounted payback, how do we calculate the discounted payback? For the discounted payback, first of all, you need to understand that what are the discounted cash flows going to be. So like, for example, if you have got, even if you have got a constant cash flow, let's say you have got cash flows of $25,000 year 1 till 5, and you've got investment of 100,000, and you have got the discount rate of 10%. Now what's actually going to happen? Try to understand. You would say year, you would say cash flow, you would say discount factor, you would say present value, and then you would say cumulative present value. Now what's actually going to happen? 0, 100,000, at time period 1, you would have 25,000. You would say 1.1 power minus 1, probably whatever the amount is going to be. Let's say if I say, let's say I say 22,500. So what is actually going to happen is that you would say 77,500. And then year 2, 25,000, it's 1.1 power minus 2. Maybe let's say if I say 20,700, maybe let's say. So then you would have this cumulative present value and so on and so forth. It will go on and on and on and on. Now, so if I try to actually tell you people, I repeat, if I try to tell you people something about this whole cash flows and discount factors and so on and so forth. So what is actually going to happen? There's something that's going to happen, which is that you would say here, cash flow, discount factor, present value, the cumulative present value. That's how things are actually going to operate. And then on the basis of this cumulative present value, you would decide where the payback actually falls. I bid on the basis of the cumulative present value, you would decide where the payback actually falls. I bid you would decide where the payback actually falls. Now, the second thing is that when we talk about the concept of net present value, which is the NPV. So what happens is that what is this NPV all about? When we talk about the NPV, we simply say present value of inflows minus present value of outflows. What do? We say present value of inflows minus the present value of outflows. Now, when we talk about the present value of inflows minus the present value of outflows, let's try to have an understanding of something. Basically, what we do is that we try to calculate, we try to create a pro forma for this. And the pro forma that we calculate, create that goes like this: sales, cost of goods sold, other expenses, depreciation, let's say, profit before tax, tax, depreciation, the interest, the investment, working capital, cash flows, discount factor, then there is this present value. Now, a lot of you people would be wondering that why I've written things. I'm just going to explain each one of them. This, I'm just going to explain each one of them to you. Okay, so how do we calculate the net present value? Let's just try to understand this thing, that what exactly is the NPV all about. I'll share notes with you, don't worry. Now, when I try to calculate the net present value, let me just explain to you people. Basically, every one of you understands that it's just like a normal P&L. Sales is there, the cost of sales is there, other expenses are there, depreciation is there. Now, the problem with the depreciation is that the depreciation is a non-cash expense. I repeat, the problem with the depreciation is that the depreciation is a non-cash expense, right? That's what the problem with depreciation is. Now try to understand something. You've got sales, you deduct the cost of sale, you deduct other expenses, you deduct the depreciation, you resultingly get the profit before tax. When you have the profit before tax, what you do is that you calculate tax upon it. What do? You calculate tax upon it. And after calculating the tax upon it, this depreciation is added back again. Like if it was 100 outflow here, it's 100 inflow over here. That's what we do. Now, why did we actually minus the depreciation? We minus the depreciation because, I repeat, we minus the depreciation because what we wanted to do was we wanted to actually calculate the profit which is eligible for the computation of the tax. So we did actually minus it. Now let's move a bit forward. The interest is never shown in the NPV calculation. So I just wrote down the interest just for the sake of explaining to people that it should not be shown. I repeat, I intentionally wrote down this specific interest just to show you that it is not shown. Why is it not shown? The reason that it is not shown is that the interest, I repeat, the interest would actually be incorporated through the discount rate. I repeat, the interest would actually be incorporated through the discount rate. Now let's move a bit forward. When we talk a bit forward and when we discuss further, now what next is there? Let's try to understand this. The next thing is investment. So whatever your investment, whatever the outflows that you have, that outflow is shown here. Now, next situation is that when you show these outflows, what next is there? There is this something. I repeat, let me tell you, there is something. This is an inflow. So this is actually about the residual value. I repeat, this is actually going to be considered as what? This is going to be considered as residual value. What is it going to be considered as? It's actually going to be considered as residual value. Now, what next is there? Next is there is the working capital. Now, when we talk about the working capital, you see there's an outflow, 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 and here is an inflow. So I'll just tell you about the working capital, that how do we actually incorporate working capital generally. So you see, when it comes to the working capital, it's always invested at the start of the year. I repeat, the working capital is invested at the start of the year. So when we have the working capital which is invested at the start of the year, how do we go about this? When we say the working capital is invested at the start of the year, so that means if you need working capital for year one, it's gonna be invested at 0. If you need working capital for year two, it's gonna be invested at time period 1. If you want working capital at year 3, it will be invested at time period 2. So that's what the working capital is actually going to be all about.
Allow me to subscribe. Oh, thank you.
Right? Okay. So working capital is invested at the start of the year. Now there is one more thing that I want you people to understand, which is basically at times the examiner would tell you like this. He would say that the working capital required is the working capital that we required is 20% of next year's sales. And let's say it says that here the sales, year 1, 2, 3, 4. The sales is expected to be 100,000, 220,000, 300,000 to 70,000, let's say. So what happens is that the working capital at the rate of 20% is gonna be what? Is gonna be 20,000. So when you say 220 into 20%, how much does it turn out to be? How much is 220,000 into 20%? 300,000 into 20% gives you 60,000. 270,000 into 20% gives you how much? 54,000. So what happens is that what do you input? You actually input incremental working capital. How do we get about incremental working capital? 20,000 invested at time period 0. Then what happens is additional 24,000 invested at time period 1. Then additional 16,000 invested at time period 2. Then what happens is 6,000 is recovered at time period 3. And in time period 4, this is whole gonna be recovered. So basically what you would be showing in your NPV calculation is that 0, 1, 2, 3, 4. What you would be showing is that you would be showing 20,000 here. You would be showing 24,000 here. You would be showing 16,000 here. You would be showing 6,000 as a recovery. You're just showing 54,000 as a recovery. So that's how you're going to show your working capital over the period of the life of the asset. So I repeat, that's how you're going to show the working capital over the period of the life of the asset. So that's what you would have to keep in mind. Now, let's move a bit forward and let's try to discuss further. So that's, I've just explained to you people what the NPV calculation is going to be all about. Now then there is this actually going to be the discount rate. So the discount factor is there and then you get the PV which you multiply this by this. So you get the PV. Now I actually want to draw the attention of you people to something that is actually going to help you understand something more, which is basically a video that I published, I think around some time back. And this specific video was about how you deal with the spreadsheet in the examination. So what I'm actually going to do is that I'm actually going to show you people that how exactly can you deal with the spreadsheet in the examination and calculate the NPV, etc. Using the spreadsheet. So I've got very precise or a shortcut way of doing it. I'm just going to guide you people. You could see in front of you that there is basically I think you people have been added to some WhatsApp group also, and more people would be added up. You could just go on to Scribber Academy and you could search, you could just search Scribber Academy on the YouTube. When you would search Scribber Academy on the YouTube, you would find out this channel. You could search on the playlist. And in the playlist, what you could do is that you could just go about sorting the playlist with the latest video added. And when you would go about this, you would find a video for, I think there is a playlist for ACCA AFM. You see here, you click on this ACCA AFM playlist. Now you would go into this ACCA AFM playlist. There are a lot of things that are actually there in the AFM playlist. But what I want to draw your attention to right now is basically, I think this is this video, which is the ACCA CB practice platform. It's a video which actually guides you that how exactly are you going to use the formulas and all that in order to calculate the video. So let's say if I try to calculate this, how exactly am I going to do it? Let's just try to see this. Okay, so you get it. This is what it is. This is a short video where I've actually told you people, where I've actually guided you people how do you use the CB practice platform, and in order to calculate how do you use the CB practice platform, and on the basis of CB practice platform, how do you actually do the NPV calculation and all that. So this is something that you would actually have to that you would actually have to um, what you would actually have to see, because this video is important. You are gonna get a lot of guidance through this video. It's a 40-minute video, but it's amazing video, and it's gonna help you understand this a lot. So just try to go through this video now. So I've actually gone through the NPV thing. Now there is this next thing which is actually called the concept of IRR. The IRR, which is the internal rate of return. What is the formula for IRR? It's A% plus capital A divided by capital A minus capital B multiplied by B% minus A%. So what actually happens is that when we talk about the IRR, what exactly is the IRR? IRR is the discount rate at which NPV is zero. I repeat, IRR is the discount rate at which NPV is zero. So what is it? It's actually the discount rate at which NPV is zero. All that you have to do is that you have got these cash flows here. You've got these cash flows here. You've got this discount factor 1. On the basis of this, you get the present value 1. You use another discount factor and you get the second present value. So in generally what happens is that we try to calculate the IRR. We say that A% is basically the lower percentage and A is basically the NPV at A%. The B% is the higher percentage and capital B is the NPV at B%. That's what it is. So on the basis of this, what you do is that you calculate the IRR. I repeat, on the basis of this, you calculate the IRR. So basically, when we talk about the concept of IRR, what exactly is this IRR all about? IRR is the discount rate at which NPV is zero. Now, so a lot of exam questions you come across this IRR calculations also. Okay, I'm going to take short break of 10 minutes and then I'll resume after 10 minutes. But as of now, before I go on to the break, I'll have a quick discussion with you people. I've got the first one, Chiomi Izema. Chiomi Izema, how are you?
I'm fine.
Okay, so is this revision helping you out?
Yes, it is. You are trying to refresh back what we've done before. That's great. Thank you.
Okay, any specific thing you are looking at?
I'm getting the whole basis. So we are still in investment appraiser. I'm looking forward for the mergers and acquisition and all. So I believe we'll get there.
Okay, lovely. I'll just inshallah try to go through that.
All right. Thank you.
Thank you.
Yes.
Okay, I've got Christina Thaiba. Christina, how are you? Yeah, Christina, you can hear me? Can you hear me? Okay. I've got Chucks Chikwendu. Chucks Chikwendu, how are you? Okay, I have got Cohen Cabera Biro. Cohen Cabera Biro.
Yes, I'm okay. How are you?
I'm good. Which country are you from? Nigeria?
Uganda.
Oh, you're from Uganda. Okay. So, yeah, you understanding this whole? Are you enjoying the session?
Yes, I'm enjoying the session. I've just gotten leave right now, and unfortunately, I didn't attend class. So I'm counting on this session to bring me up to speed before the 9th of September.
Okay, what I would suggest you to do is that this session's video is also going to be available. Plus, there was a playlist that I actually referred to. I would just try to make sure that I share the link of the playlist in the WhatsApp group also. So you could refer to that playlist also for the preparation. It's going to help you a lot.
Thank you very much. I'll appreciate.
You're welcome. Okay, the next I've got is Dawn Fortunate. Yeah, Dawn Fortunate, can you hear me?
Yes, I can hear you, sir.
Okay, so you have any queries, lady?
Apparently no queries. I'm okay with the session. It's going so well.
Okay, lovely. Ivan Zinzinga, sorry.
Good evening, sir.
Good evening. You're from South Africa?
I'm from Uganda, but I'm in India.
Sorry?
currently. I'm from
Hello.
Uganda,
Oh, you're from also Uganda. Okay, lovely.
but in India.
So, okay. So you have any queries for today?
Not really, sir. Everything's fine. Looking forward
Mhm.
towards like reconstruction and organization.
Mhm. I am gonna come on to that. Don't worry about it after the break. After the break, I'm gonna come on to that. Okay, I've got next, which is James Ahibua Kisembo. James. Thank you, Ryan. Okay, then I've got Joy Amadison. I don't know. Sorry if I pronounce your name incorrectly.
That's fine. That's fine. That's fine.
Okay. So, how is this session going for you?
Yeah, fine. It's succinct and up. It's very concise and to the point. I really gained a lot. There are a lot of things I felt they were just minute. They were not really, something I need to go back to. But I think it's a very wonderful lecture. Thank you.
Lovely. Thank you, Ray. Thank you. Okay, I've got Kristen Rollins. Kristen, how are you?
I'm good. I'm good. How are you?
Oh, I'm good. I'm good. So, you have any queries for the session today, right now?
No queries so far. Most of the stuff I pretty much comfortable in. So going through the stuff you went through already this morning was really just a good refresher. I'm looking forward to probably I guess corporate reconstruction and financing.
I'll share that. Don't worry about it. Thank you. Okay, Linda, how are you?
I'm good, sir. And how are you?
I'm good. So the revision is helping you?
Very helpful, sir. I remember in the afternoon as I was doing my revisions, I had challenges to understand the equity better and the asset better. But after this session, I now understand very well. Thank you.
Thank you. Alhamdulillah. Lovely. I'll just continue on doing more things also.
Thanks.
Okay, Lucky Muka, how are you?
I'm fine, and how are you?
I'm good. So the session helping you?
Yes, it is.
So how's the preparation generally?
The preparations are going on well.
Uh-huh.
I must mention that I'm sitting in December. We missed the here in Zambia. I don't know what the problem was on the last day of pay. Most of us found the places fully booked, so we have no option but to December. Yeah, but I've continued preparations with the preparations, and I must say it's going on very well. Yeah.
Okay, lovely. Inshallah. Hopefully you will get. You will be prepared for
I
the.
still just have a bit of a challenge. Yeah, I still just have a bit of a challenge when it comes to share exchange on what you call mergers and acquisitions. I'm still lagging behind on that. Yeah, perhaps maybe along the way, I'll get a grasp of it. Yeah.
I will just, I mean, like, I'll just do it once I move forward after the break, inshallah.
Okay.
Okay. Okay, Oluchi and Z, any queries you have?
Hi, good evening.
Hello, good evening. You have any queries?
Queries for now?
Uh-huh.
No, not no.
So the revision is helpful
But
for
yeah,
you?
I mean, very helpful. Thank you.
Okay.
I had mentioned on Sunday that it was to touch on risk management. So if we have any time, we can just breeze through it. That would be helpful. Interest
I'll
rate.
just try to do that. Don't worry about it. Inshallah. Okay, I have got Omotola, so one day.
Yes, good evening.
Good evening. So how are you, lady?
Yeah, I'm fine. I'm fine. Session has been interesting so far. I'm Can you hear me?
Yeah, I can hear you.
Yeah, I'm looking forward to more expository, webinar. Yeah.
Okay. My agenda for today is majorly that I want to cover up the revisions. Again, I know, a lot of people might actually be looking at something like calculations or something, but unfortunately, that's not the agenda for today. The agenda for today is majorly to have a quick revision of all the areas. So hopefully, inshallah, I'll just, you might actually go through that, what do we call, the playlist of the YouTube, and you could get a lot of lectures from there also. Right. Okay, I've got Rashail Hamonga Mafu. How are you?
I'm okay, sir. How are you?
I'm good. I'm good. So you have any specific queries right now?
Maybe measures and acquisition and risk management. Callers. Yes.
Okay, I'll just try to do it, inshallah. I'll just try to do it. Okay, I've got Ryan Rafi. Ryan, you have got any queries right now?
No, sir. Thank you.
Okay, lovely. Okay, I've got Thaula Abigail. Thaula, you've got any queries right now?
No, sir. No questions. The session is going on well. Looking forward to risk management, though.
Okay, I'm just gonna come on to that after the break. No worries. Okay, Lady Yolanda, how are you?
I'm good, thanks. And you, sir?
How is the preparation this time around?
I'm much better than before.
Okay, lovely. All the best. All the best.
Thank you. It's just
Okay, guys. So we have a break for, right now the time is for me it's 10:38 p.m. I'm gonna take a break till 10:48 p.m. I'm gonna resume again at 10:48 p.m. In the meantime, you people could just explore the YouTube playlist. Like, all that you have to do is that you just have to go on to the Escribir Academy channel, and you could just look out for the playlist of the AFM. And in case if any one of you could actually share the link in the relevant groups also. So we'll just start off in 10 minutes. Okay, let's move a bit forward and let's talk about another technique, and that is called the technique of adjusted present value, which is also called the concept of APV. Now let's talk about the concept of adjusted present value, the APV, that what exactly is it all about. So when I talk about the concept of APV, the APV is a modified version of the NPV calculation. In fact, it's an advanced version that overcomes a lot of limitation for the NPV calculations. The formula for the adjusted present value calculation is that it says base case NPV. Base case NPV plus present value of financing side effects. What is it? It's base case NPV plus present value of financing side effect. Now, what exactly is this base case NPV? So the base case NPV is the NPV calculated on assumption that the project is 100% equity funded. So when we talk about the base case NPV, the concept of base case NPV is that it's an NPV calculated on the assumption that the project is 100% equity funded. And then we have got the present value of financing side effects. The presenting value of financing side effect actually includes multiple things. And those multiple things actually include the issue cost. The second thing that actually includes the tax savings due to interest. The third thing that it actually includes is that net interest saved. And the fourth one of them is basically spare debt capacity. So when we talk about the concept of APV, the adjusted present value, what exactly happens with the APV? The concept of APV is that it's the base case NPV plus the present value of the financing side effect. And the base case NPV is the NPV calculated on the assumption that the entity is 100% equity funded. Now, how do we calculate the base case NPV? So for the base case NPV, what you do is that you calculate the normal cash flows. And then those normal cash flows, what you do is that you discount them using the discount factor. Now, problem is that when we talk about the discount factor has to be the all equity rate. It's actually the discount rate, which would mean that the entity is 100% equity funded. There are two ways of calculating it. What are the two ways of calculating it? One of them is you could either use the CAPM model or you could either use the MM2 proposition. So what actually happens is that when we talk about the CAPM model, you could say the normal formula is KE is equivalent to risk-free rate of return plus equity beta into RM minus RF. That's the normal formula. But what actually happens is that when we talk about this, the all equity rate, instead of the equity beta, you use the asset beta. I repeat, instead of the equity beta, what do you use? You use the asset beta. So you say KE is equivalent to risk-free rate of return plus the asset beta into RM minus RF. Now, similarly, when we talk about the concept of MM2, so what exactly is this MM2? In the examination, you are being given this formula sheet, and within this formula sheet, you are being given the formula for the MM2. The formula for MM2 is actually this. I repeat, the formula for MM2 is actually this. Now, what exactly is this formula going to be? So you've got one of them is the ungeared cost, one of them is a geared cost. So what actually happens is that you know that this is basically the market value. Sorry, this is actually the market value of equity. This is market value of equity. This is market value of that. This is KD. This is tax rate. So you've got one ungeared cost of equity and the other one of them is the geared cost of equity. So basically what happens is that this is ungeared cost of equity. What is it? It's an ungeared cost of equity. So what actually happens is that you try to calculate the ungeared cost of equity. So basically this ungeared cost of equity or the KE where the asset beta is used as a discount rate. So you get the base case NPV. Then what happens is that you've got the present value of financing side effects. What exactly are the present value of financing side effects? When we talk about the present value of financing side effects, The present value of the financing side effects would actually mean what? The present value of financing side effects would mean that the present value of financing side effects would mean that number one is the issue cost. So for example, when you have taken the loan, so there are usually the issue costs that you incur as an entity, like maybe 2% of the funds borrowed or 1% of the funds borrowed or whatsoever. Let's say 1% or let's say 2% or so on and so forth. So that is actually going to be considered as what? As your issue cost. Now try to understand something. Try to understand something which is basically when you talk about the issue cost could be the issue cost on loan, the issue cost on equity, etc., etc. The issue cost could be tax deductible. The issue cost could be tax deductible. The issue cost could be non-tax deductible. Now, what is actually going to happen is that if the issue cost is tax deductible or the issue cost is non-tax deductible, let's try to understand this. When we talk about the issue cost to be tax deductible, when the issue cost to be non-tax deductible. So like, for example, if you had a issue cost of 100,000 and there is a tax rate of 30%. So what would happen is that 100,000 minus 30,000 net issue cost of 70,000 is what you're gonna get. Net issue cost of 70,000 is what you're gonna get, right? The second thing is that present value of tax saving due to interest. Now, what exactly is this present value of tax saving due to interest? Try to understand this thing. When we talk about the present value of tax saving due to interest, the concept of present value of tax saving due to interest is that, let's say you have taken a 8% loan, 100,000, and let's say the tax rate is 20%. So what would happen is that every year when you would have this interest expense, 100,000 multiplied by 8% gives you 8,000. So you would have a tax savings at the rate of 20%, which is going to be 1,600. So what you would do is that, let's say if the term is for 5 years, you would say year 1 till 5. So what would happen is that you would say the tax savings is 1,600. The discount factor is going to be 5-year annuity factor at the rate of 8%. I repeat, the discount factor is going to be the 5-year annuity factor at the rate of 8%. So resultingly, what would happen is that you will end up getting the present value. I would repeat, you will end up getting the present value. So there could actually be the present value of tax saving due to interest. The third thing is that net interest saved due to subsidized loan. Now, what exactly do you mean by net interest saved due to subsidized loan? So the concept of net interest saved due to subsidized loan would actually mean what? This would mean, for example, the normal interest rate is 10%. And let's say if you get a subsidized loan for, let's say, 7%. So therefore, there is actually a saving of 30%. Sorry, 3%. There's actually a saving of how much? There is actually a saving of 3%. Now what actually happens is that if there is a saving of 3%, so what would you do with respect to this saving of 3%? With respect to the saving of 3%, you would say that what is the tax rate? So when we talk about the tax rate is going to be like this. You would say, let's say, if the loan that you have taken is of 100,000. So if the loan is of 100,000, so you would say the interest saved is 100,000 into 3%, gives you 3,000. Then what happens is that if the interest saved is there, so what would happen is that there is going to be extra tax at the rate of, let's say, 30%. So 3 3 is a 9, there's going to be 900, and then 2,100 is going to be the net interest saved. Again, if let's say if it's a 5-year loan, so what would happen is that you would say 5-year annuity factor at the rate of 10%. Why? Because 10% is the normal KD. So whatever the 5-year interest rate 3.179, you would multiply it with this, and resultingly you would end up getting this amount. So basically, if I try to discuss something, I would actually tell you that this is how you would get the net interest due to subsidized loan. So if you want to calculate the APV of a given investment, how would you do it? You would say base case NPV plus present value of financing side effects, issue cost, present value of tax saving due to interest, so hence resultingly, what are you going to do? You're going to say that the issue costs are there, this is there, this is there. Hence resultingly, you would have the APV. You would have the APV. So that's about the APV, the adjusted present value. Next, there is another technique, and that's called modified IRR, the modified internal rate of return. Let me just guide you that what exactly is the modified IRR. Modified IRR is one of those technique that actually overcomes the limitations of IRR. So the limitations of IRR are actually overcome by this modified IRR. And when we talk about this modified IRR, the formula for the modified IRR is also given in the formula sheet. When you would look at the formula sheet, you would find out the formula for the modified IRR. Now, what exactly is the formula for the modified IRR going to be? Let me just guide you through each one of them. So basically, this PVR is the present value of return phase. This PVI is the present value of investment phase. The N is the life of the project. RE is the reinvestment rate. RE is actually the reinvestment rate. What? It's actually the reinvestment rate. So resultingly, what are you going to get? You're going to get ultimately a situation where you would have the MIRR. The MIRR is again expressed in terms of percentage. And if you have to decide that you should make an investment or not, how do you decide whether you have to make an investment or not? So for that, you need to understand something. What is it that you need to understand something? You need to understand something that is basically you compare it with a WACC. For example, if it is greater than WACC, then the project is a good. If it is less than WACC, the project is not good. I bet. If it is better than WACC, the project is good. If it is not greater than WACC, then the project is not good. That is something that you would have to keep in mind. Now, let's move a bit forward and let's discuss a bit further. Yeah, you've been given in the exam the reinvestment rate. You people know that there is basically the video. So in this video, there is also the MIRR calculation also. I bet in this video, there is an MIRR calculation also using the formula of the that is available in the spreadsheet. Right? Okay, let's move a bit forward and let's discuss a bit further. So the next one of them is basically called another concept which is called free cash flows. Now, when we talk about the concept of this free cash flows, what exactly is there in the free cash flows? The free cash flows actually mean the cash flows available after fulfilling the business needs. So whatever the cash flows that you have, that you require for the fulfillment of the business needs, whatever the extra, whatever the surplus cash that is available, that's going to be called the free cash flows. The free cash flows are actually of two types. One of them is called free cash flows to firm. The other one of them is called free cash flows to equity. So I repeat, one of them is called free cash flows to firm, and the other one of them is termed as free cash flows to equity. So FCFF, FCFE. This free cash flow to firm is the cash flow available for distribution to providers of finance. Now, what exactly do you mean by cash flow available for distribution to providers of finance? It's basically the debt plus equity provided. The cash flow which is available for distribution to providers of finance is the free cash flows to firm. Now, when we talk about the cash flows available for distribution to providers of finance, is called the free cash flows to firm. So who are the providers of finance? The debt provider, the equity provider. And when we talk about FCFE, the cash flows which is available for distribution to equity providers. So that's called free cash flows to equity. Now let's just try to understand something. When we talk about FCFF, when we talk about FCFE, the FCFF is simply profit before interest and tax. You apply tax on it directly at whatever percentage, let's say 30%. And then what happens is that non-cash expenses add up. Reinvestment is actually deducted. Additional non-current asset is again deducted. So resultingly what happens is that you end up getting the free cash flows to firm. At times what happens is that in the given scenario, you might not actually be given this PBIT. You may actually be given PAT. So if in the examination scenario, if you have been given PAT, how would you do? You would start off with the PAT and you would add up after tax interest to it. What is this after tax interest? It's the interest amount multiplied by 1 minus 2. And then the rest remains the same. The rest remains the same. So basically what happens is that PAT after tax interest and the rest remains the same. Let's move a bit forward and let's talk a bit further. When we talk about the next one, which is called the free cash flows to equity, what exactly is the free cash flows to equity going to? It's the same thing except that under the free cash flows to equity, you would start off with a PAT, then you would say non-cash expense, then you would say reinvestment, then you would say additional non-current asset. You get it? That's called free cash flows to equity. Abid, what is it termed as? It's called the free cash flows to equity. Abid, what is it termed as? It's termed as free cash flows to equity. Okay, next. Okay, is the audio there for all of you? Are you all listening me? Are you all able to hear me?
Yes, sir.
Okay, lovely. Now, at times what happens is that, basically, you have to calculate the value of the business also at times. So just try to understand the value is usually the present value of future cash flows. So when you have the present value of FCFF, so this present value of FCFF is calculated using WACC. What you do is that you discount the free cash flows to firm using the WACC. The result that you get is that you get the value of firm. And the value of the firm is actually made up of two things. The value of firm is actually made up of two things. It's made up of value of debt plus it's made up of value of equity. It's made up of value of debt, it's made up of value of equity. So when I talk about the present value of free cash flows to firm, so remember the present value of free cash flows to firm, the free cash flows are discounted using weighted average cost of capital. And when they're discounted using WACC, ultimately what do you end up getting? You end up getting the value of firm. The value of firm includes the value of debt plus the value of equity. Similarly, when you have got the present value of free cash flows to equity, the present value of free cash flows to equity is calculated by discounting them using the KE, the cost of equity. And when you discount them using the cost of equity, what do you end up getting? You end up getting value of equity. So a lot of cases, what happens is that the value of the business is calculated using the free cash flows. So you would come across the scenarios, you would come across the situations where the value of the business would be calculated using the free cash flows. Now again, what happens is that it's the future cash flows. I repeat, it's the future cash flows that we have to talk about. Now, if we have to talk about the future cash flows, so just try to understand this thing. A lot of scenario examiner would say that the free cash flows right now is basically, let's say 100,000, and they are expected to grow by 4% till year 3 and then by 2% till infinity. And what happens is that the WACC is, let's say, 10%. So what are you going to do? You're going to say that if you have to calculate the value of this business, you would say here cash flow, discount factor, present value. Now, what are you going to do? You're going to say here 1, 2, 3, 4. Four till infinity. Now was 100,000. So in year 1, it will be 104,000. Then how much is that? After 104, if we multiply it by 104, 1.04 again. And then it has to be 1.02. Right now, let's just try to understand few things. I bet let's just try to understand few things. Basically, what happens is that what are you going to do? You're going to say that there is a discount rate of 10%. Now, for this one, what are you going to do? There's actually a terminal value that you would calculate. You would calculate the discount rate like this. You would say 1 upon 10% multiply by year 3 PV factor. Like it's 4 till infinity. So when you do 1 upon 10%, you bring the cash flow at year 3 level. From the year 3, you have to bring it to 0 level. So like when you have actually 4 till infinity, if you discount them, you reach that at 3 level. So you have to bring that from 3 to year 0 level. So how do you do it? You would do it like this. You would say 1 upon 10% multiply 1.1 power minus 3. So hence, resultingly, whatever values that you get, this is going to be considered as the value of the business. Whatever that you get, you will end up getting the value of the business. Right? Yeah, it has growth. So the growth is incorporated in the cash flow, na? I've incorporated the growth in the cash flow. You get it now? Okay, good enough. Now what actually happens is that if I could come on to this playlist actually has got this mergers and acquisition. The video number 2 is about mergers and acquisition. So you could just try to go through the merger and acquisition from the playlist. Then you could just try to go through this restructuring also. Even you don't go through the whole playlist, just go through these things which I'm actually telling you. Islamic finance from video number 12. Because it is part and parcel of the course. BSOP model from the video number 14. Video number 19, CBE tricks. Now, so that is what you have to do. So basically investment appraisal, restructuring, merger and acquisition, this is all going to be covered up. Now, what I'm actually going to do now is that I will try to have a session maybe tomorrow, or maybe I would just do the uploading of this. So I would just be doing one of the uploading for the currency and the interest rate risk management. So that what happens is that you get the whole syllabus revision, because you see what happens is that when it comes to currency and the interest rate risk management, every tutor has a different way of teaching. Every tutor has a different way of solving the things. So my personal understanding is that for the currency and for the interest rate risk management, I would try to actually create some specific examples under which I would try to conclude this within 45-50 minutes, the whole currency and the interest rate risk management. So maybe I might do a class tomorrow, or maybe I might upload the recordings. So there is something that I can actually, I'll probably do with relation to this. It's the AFM playlist. Are you in any of the WhatsApp group?
Yes.
Okay, so I think somebody has already shared that in the WhatsApp group. And I've shared it again, so you'll get it. So I'm just gonna keep it till here. Okay, in case if any one of you is not in the WhatsApp group, you could just message me on this number. I'll share the link. This is my number, Lukman Rafiq. You could also contact the admin also. Yes, Ryan, I'll just share. You could also contact the admin on this number. Right? Okay. So thank you very much, guys. Thank you for your time. Thank you for attending the session. It was great to have you all here. And inshallah, I hope that you people would benefit from the resources that I've shared with you people, and you would actually be able to benefit a lot from whatever that we have discussed in today's session. So thank you. Thanks a lot again for attending the session. It was great to have you all here.